Welcome, everyone, to the 361 Firm Capital Blockchain Venture Deep Dive. Just before we get started, I have to go through just a quick bit of housekeeping, so we'll do this as quickly as possible. Just a couple quick rules. This session's a bit different than the last ones. Number one, remember to onboard via the diagnostic. You've done it if you're here, but that's just for ongoing presentations. But number two, this is a 361 PCI session. So we're going to see some strategy specifics, and so we won't have the no pitching rule, and I'll talk more about that later. Number three, just watch the recording rules. I just turned on the recording. This meeting is being recorded, but it's not being distributed or shared across social platforms. Number four, the capital raising notice in the bottom right there. I have to read this to you quickly. 361 Firm Capital, LLC may include in these materials or events companies in which 361 Firm or its affiliates may have an equity stake and or which are clients for which 361 Firm and any other affiliates or its broker-dealer Stonehaven could earn a fee from raising capital. Okay, great. So that done, Nishant, please enforce the no AI note takers rule. Speakers, please remain on camera. And audience, please remain on mute and off camera unless you're speaking. And for the Q&A, which we are going to have at the end, please submit your questions via the chat or raise your hand with the Zoom feature. Okay. Thanks for that. Whoops, went a bit too far ahead. All right. So on September 6th and September 13th, we had a couple of blockchain venture landscape sessions where we talked about use cases, technology, entrepreneurship, intellectual property, regulatory issues, financing, and investing. Here's some key takeaways just to summarize those sessions, which are available on the 361 YouTube channel. Blockchain provides a digital source of the truth, and not just for financial use cases, and as such supports use cases requiring data scalability, data provenance, AI governance, Web3, identity management. But a lack of regulatory clarity constrains capital deployment to a full pipeline of technology and intellectual property developments. However, a way forward using basic risk management could be to separate speculation and investing and avoid blurring the two. That's a why question, which could clarify areas less affected by hype and regulatory headlines, what the financial versus non-financial use cases of blockchain are really about, and what the appropriate fund structure should be for managing liquidity in blockchain investments. So today, we're going to look at what has the 361 community actually said about blockchain, what are the risks to be managed, and the details of why fund structuring matters, more specifics of the what, when, why, and how of venture investing in blockchain technology, and take a look at a specific strategy. So let's introduce our speakers. Joe Milam, there he is. He's the founder of AngelSpan and Legacy Funds. Hi, Joe. AngelSpan provides investor relations for startups, while the Legacy Fund's venture as a service platform enables solving funding gaps in licensees' communities. Joe is a recognized expert in securities analysis, venture and angel investing, and the psychology of wealth, and is also a frequent 361 Firm community contributor. Andrew Hoppin, say hi, Andrew. He's a managing general partner and CIO at Chainlink Capital Management. Chainlink Capital is a fund of funds that invests in deeply technical blockchain technology and digital asset fund managers. Andrew is an open source civic tech entrepreneur, a former government CIO, passionate about building a more decentralized, egalitarian, and democratic planet, and frequent 361 Firm community contributor. And on a plane currently is Bill Deichler. He'll be joining us soon. Presently, the chief investment strategist for Chicago Atlantic, which currently is involved with digital mining. And you heard from Bill's colleague, Ryan Maranaka, on our webinar on September 6th. However, Bill was also an LP in the space when previously CIO for two family offices and initially got his feet wet with digital assets in a GP capacity with Morgan Creek and their early stage VC blockchain funds. In the last 361 community survey, the community noted that there was an interest in blockchain but not crypto. So Bill's going to go into that later and provide his broader perspective shortly. So for me, I'm Dan Hupsher, you know me, managing partner and founder of Changing Alpha Strategies. And as a 361 Firm affiliate partner, I'm your moderator today. So without further ado, Joe, can you take us till about, take us till about the next 7-8 minutes, so about 2:20. Start us off with risk. Are you pro blockchain? Are you a skeptic? Are you neither one? And what are the risks?
Well, I think, as we covered in our prep calls earlier, that I view the blockchain very in a similar lens as I did the internet back 30 years ago. It's way beyond my technical pay grade to understand the ins and outs, just like the internet. But I think the only decision you're making in getting interested in blockchain is it an enabling technology that's going to be around a while or not? Or is it just a shiny object that's going to be cool for now, and you can sprinkle some money and hopefully grab something that makes you some money? And I would fall in the former category. I think it's a serious technology, and I don't think that's brain surgery, and it certainly wasn't my opinion. I didn't do that through analyzing the technology. So I would say I'm favorable to blockchain as an interesting space to invest in. But again, I'm always informed by my prior experiences during the 90s when the internet was an enabling technology, but at the same time, you get a lot of people rushing in it and trying to throw something against the wall and see if it'll stick. And that has its own manifestations of both positive investment results, but also it does incentivize a lot of bad behavior from investors in really thinking they're investing when they're really gambling and getting caught up in the sort of the FOMO of something new and improved. And to reflect back on, again, if you could do it over again, how would you invest in the internet if you had a bunch of money in the 90s? And clearly picking the winners who became the eventual winners in the 90s proved to be almost impossible unless you got lucky. If you had taken more of a portfolio approach to say, this is an interesting space to invest in, and I'm going to deploy capital, not try and figure out this new technology and try and pick winners. But if I'm going to deploy capital, how would I do it well to capture what you're projecting to be an interesting technology that could create some real economic value? Just not knowing which of the individual companies might have the technology that becomes a real viable business and using the new technology to create a real economic value. And the research that I've been assimilating, and that's been produced by a number of academics and a number of folks over the last numbers of years, are pointing out that whether it's blockchain or the internet or virtually any new material technology or any material venture thesis, the smart thing to do, and wait for it, this is earth-shattering investment philosophy, diversify. Take a portfolio approach. That's if you're serious about actually capturing the value that can be created from a new technology or just the value creation process of innovation in general. The smart thing to do is to manage risks. And diversification is simply the process of managing transaction risk, or what the academics call non-systematic risk. That is the risk that's specific to an individual company. Again, this is applicable in the private markets as obviously it is in the public markets. The diversification is what makes sense. So how do you diversify and take an investment approach that allows you to position yourselves to capture the asymmetric returns from what looks to be a pretty serious and enabling technology called blockchain? And the other most important risk to manage across all venture, this is where venture asset class and public markets diverge, excuse me, is timing risk is the number one risk. And academics label that systematic risk. And just as it's been well discussed and well studied in the public markets, nobody can time the market. And whether the market is a broad financial markets like the public markets, or whether it's the market around a new company or new technology or asset class, there are vagaries that cause relative degrees of enthusiasm, or as we're going through now, a series of serious contraction. People's risk appetites are collapsing as we speak. That is the manifestation of what's called systematic risk or timing risk. And it's well known that the only way to manage timing risk, and it's again well discussed in the public markets, is dollar cost averaging. Now, that's the little definition or buzzword for investing over multiple time periods, so that you're willing to admit to yourself that you can't get the optimal timing right on any of those transactions, whether it's your first investment or subsequent investments. You're never going to get the timing right, but at least you have a discipline to structurally protect you from yourself, to think you can, and protect you from the FOMO that typically takes place around something that's hot or new and improved. The crowd, broadly defined. And we can go back through history. This crowd behavior manifests. It's just human nature. But there are structural ways to manage human nature so that you can be more of an investor and less of a participant in just crowd behavior. And again, we're living through that right now, obviously, in the blockchain. And the crypto, I'm not even going to discuss crypto. Crypto is got its own behavior and its own crowd. And, it's the meme stock crowd. It's the FOMO crowd writ large is largely what the crypto traders and the headlines are celebrating. So I don't even want to bother with that. So the key to investing well in any asset class, but particularly those like venture technologies and new ones like the blockchain or the internet before, is A, recognize you're not going to get the timing right. B, for crying out loud, diversify. For crying out loud, diversify in how you're spending the capital. Diversify across companies and across time. It's not brain surgery, but you have to protect your money from your own emotions. And that's what seems to be sorely lacking, particularly in the venture asset class. And the timing risk issue is particularly important because unlike the public markets, you can't sell the asset. If you were wrong in your thesis or really wrong in your timing, or you have, as we're going to discuss later, liquidity issues yourself in your own circumstances, where while you might have committed to an investment strategy, things happen in life, divorces or other opportunities or whatever, where liquidity becomes an issue. In the venture asset class, you don't have the ability to sell something to go redeploy those dollars wherever you intend to. And so it makes it even more important to deploy capital in a disciplined way over time, because that literally allows you, and you retain the optionality or the flexibility should something else arise in your personal situation or conditions that says, or the marketplace. It could have been, oh gosh, I was wrong. This isn't going to be as big as what we all thought it was. I'm glad I didn't spend all my money in that first blush of enthusiasm. How many investors would love to reverse some of their prior decisions? On this call, I'm sure we can look at our own past, me included, and say, holy cow, I wished I didn't do that. Well, unless you learn from those lessons and apply them in future activities, you're just going to repeat history. And so the thing that I just want to reinforce is there is tremendous returns. And again, in the slide that we've got here, this is an architecture of what an optimal strategy. When you look at the research, whether it's blockchain or any other venture thesis, by the way, the research, which is linked in that bottom left corner, for those of you that want to read it and really look at the actual research with real statistical data, real proper Monte Carlo simulations, big bodies of data samples of actual venture returns. That's where these conclusions come from and been verified by multiple parties. So it's not just one person's statistical work that defined these metrics. But if you're going to build a seed stage portfolio, and seed is an interesting label in and of itself, by the way, think of it as your first round of investing, but with a seed stage company, then the optimal diversification to minimize the risk and optimize on your actual expected return is between 100 and 200 companies. So what if you invested in 100 internet startups back in 96? Were you buying some stuff that was overhyped and overpriced? Yeah. But were there some interesting things that were just taking shape? I guarantee it. And they could have been your big winners. You just didn't know who they were. And then the optimal A round portfolio is 60% of your seed stage. So the best 60 companies that you sprinkled money at the seed stage, you add more money. And the research, there's two different optimization models. And again, I won't get in the weeds here because I know we're running out of time. But the optimal amount of money to write in the first check, particularly if it's a seed stage, is only 15% of your capital. And then you hold back your dry powder so that as the cream starts rising out of your seed stage pool, you deploy 30% in the A round. But you now establish pro rata rights. So when it becomes patently obvious that everybody knows these 30 companies were really good companies, but you never knew who they were going to be at the seed round, you already have established pro rata rights to deploy the majority of your capital. You're not getting crowded out on the hot deals. You are already there. This also optimizes on your time-weighted rates of return. The majority of your money is not tied up for 10 years. And the dollar-weighted as well. The proper performance calculations that's standards in the public market performance analysis that the venture industry has worked like hell to avoid having any rigorous standardized performance calculations incorporated in the industry. So this is the way to actually invest like an adult, regardless of the thesis. But something like blockchain or the internet, or virtually the venture thesis in particular, because of its own lack of liquidity, this is critical to be able to do to deliver meaningful risk-adjusted returns for the capital you're deploying, whether it's yours, and particularly if you're a fiduciary investing somebody else's money. So.
Great. Okay. Sorry, well, just wanted to say welcome to the new joiners that have come in late, but all good. That was Joe's section, so thanks, Joe, for that. We may get some questions on that in the Q&A via the chat in the end, but right now I wanted to turn towards Andrew, and let's see how the philosophy that Joe just laid out plays out in maybe a specific example. So just before I transition to Andrew, I do need to tell you one other thing, housekeeping wise. So I know it's not on the screen, but I'll just read it to you that we, 361 Firm Capital, have been engaged by Chainlink to market the offering and are being compensated for doing so. All right. So that being said, Andrew, I think you've got slide control of your own deck. And if you could take us about another 20 minutes, 242, 245, about there. Start us off from your point of view. Why blockchain venture and why now?
Yeah, absolutely. And just to make sure you're seeing my deck okay?
Yeah, I'm going to stop my share and give you share controls. Yep.
Great.
So yeah, seeing yours.
Okay, great. Great. Thanks so much, Dan. So yeah, we are Chainlink Capital Management. We run a very unusual thing called hedge funds of funds, exclusively in the blockchain technology, digital assets, and yes, by some definitions, crypto industry. And what is even more unusual about us is that our flagship product, the one that we've been doing for more than 5 years now, is focused on early stage venture capital like assets. So we are invested primarily in teams and technology, not in markets, not in trading, certainly not in meme coin versions and definitions of crypto. We're very much, just as Joe said, in the early Web 1.0 days, trying to find the teams and the technologies that are going to be a big deal for the long run. And then we're taking what we think is a somewhat novel approach to how to get that exposure in a way that we think addresses both systematic and non-systematic risks, as Joe alluded to, in some important ways. So let's just very briefly back up a little bit. That's not really the point of this webinar, because we've just been through two great 361 group webinars about blockchain tech and the why of it. But at a high level, how we think about the utility of blockchain tech as a firm and why we have conviction that it is going to be an important technology for a long time, we can really bucket into two core use cases. And the first of those we call liquidity. And this is quite broadly defined use of the word liquidity, but really it relates to the fact that blockchains can be used to provide 24/7, always-on, programmable payment rails, and that core capability is useful for a whole lot of things that are a big deal in both institutional and consumer traditional finance. And this is why we see PayPal launching its own stablecoin on the Ethereum blockchain. This is why we see Visa settling transactions with merchants using USDC, another stablecoin. This is related to why we see BlackRock and Fidelity and WisdomTree and Invesco applying to the SEC to run Bitcoin spot ETFs, because they believe that the same core technology underlying those payments use cases also underlies Bitcoin, and that is going to be an important asset for the long haul as well. And it also underlies the work of entities like JP Morgan, which actually run their own blockchain called Onyx to provide technological capability to tokenize real world assets. And in this case, we're talking primarily about financial instruments like bonds, and being able to tokenize those and transact and settle those on a blockchain. So we believe that this cloud of use cases is a huge deal, both in terms of quantum and in terms of import to the biggest financial products and services and institutions on the planet. And so we have conviction that the underlying technologies therein will matter, and that the teams and technologies that are innovating there are going to be a good investment for the long term. And so that's why we're taking this strategy in that use case domain. The second use case domain, which is much less proven out in our view and much less far along, we loosely refer to as identity. And this is the capability to prove what something is, where it's been done, and what has been done with it, and where it has been. And you can apply that to all manner of things, but the use case that we like to think about most seminally is us as people, our own identity. And we think that in an era where AI is making it easier and easier to fake literally anything, including me talking to you here, it wouldn't be far from a stretch to have this not actually be me. It'd be difficult to prove that it is me if you didn't have new ways to prove that it is me. And so there are a number of what are called proof of humanity protocols, which are endeavoring to do things like now enable me to prove that I am human to you here and now. And we don't think it's any accident that Sam Altman, the CEO of OpenAI, his other company is WorldCoin, a company that we've had an investment in for a number of years. And whether you agree with WorldCoin's specific approach to it or not, we think that that's really strong validation that in the AI-dominated era, blockchain technologies are going to be important complementary technology in terms of putting guide rails on the truth. We also see use cases that are maybe sound more mundane that we think are actually at least as big a deal financially from an investment perspective, which include loyalty and rewards. One of our other underlying investments is working with some of the biggest payment card companies in the world to help them enable easier peer-to-peer trading of rewards without having to go through their infrastructure, providing novel ways to incentivize loyalty, and also working with consumer brands to meet new regulatory requirements that require, for example, in the EU, the tracking of literally every garment that you might buy in a store all the way through its supply chain to measure its carbon footprint. It's very hard to do that without blockchain technologies. And so we think, again, in this domain, blockchain technologies are going to be important technology for the long term, and that in our view, it's a good bet to invest in the best teams and the best technology that we can find at an early stage. So that's all I'm going to say about the why of blockchain tech. But I think I thought it was important for you to understand how we think about and how we compartmentalize the venture landscape in this domain. So now we spend a lot of time looking at how to get this exposure in blockchain tech. And the way that we do it is designed, of course, to get the strong risk-adjusted return over a long haul. And that's not an easy thing in any asset class, but least of all in an asset class like this one, which is extremely volatile and that has abundant tail risks. And they come from all corners: regulatory, political, technological, manager, like literally fraud, corruption, and greed. There are all kinds of risks that are abundant in this space. So how do we go about it? Well, we go about it with diversification and with timing that allows us to, as Joe said, dollar cost average across time. And I'll get into the structure that enables us to do that we've come up with. But we think it's important to look at timing specifically because we don't believe you can time the market, and we do think that you should have a long-term time frame. We frankly have timed the market badly. We've been around longer than any other hedge fund of funds in this industry, bar one. And we entered at just the wrong time going into the last bear market with our flagship product. And we've now gone through more than a year of another deep bear market. And in spite of that, we've outperformed our benchmark index by a country mile. And we've outperformed the S&P by a good measure over that period of time. So we are provably not been able to time the market. And yet we think the strategy has demonstrated that it can perform well across time if you believe that over a long period of time, these technologies are going to matter. So we feel good about that. We've won awards that affirm that as well. We were awarded the award for best sustained absolute performance by a small fund across a 3-year period, which again, we like that in particular rather than outperforming in any shorter time period, because really you need to not rely on timing the market and getting lucky in order to print impressive returns if it's going to really matter for investors. So how do we do this? Our flagship fund, as I mentioned, is what we call a liquid venture strategy, and that may seem paradoxical, or at least a bit odd. So what I mean by that, we endeavor to provide you with access to venture style returns and venture like assets, early stage teams and technology exposure, long, and to do so in a way that also helps you better manage systematic and non-systematic risk than a traditional technology venture capital fund might. So what do I mean by that? Well, we are structured as a hedge fund. So you have the ability to invest more money any month in this fund. You also, after a 1-year lockup, have the ability to get back, on average, most of your liquidity any quarter. So it's a very different liquidity timeframe than a traditional technology equity fund, which is going to be invested typically when upfront, drawing down your capital over a period of years and then returning that capital over a much longer period of years. So we think that's very good for managing the timing risk. You can literally dollar cost average into our fund by investing every month if you choose to. And again, we can return liquidity to you any quarter if you choose to ask for it after a short lockup. So that's one important thing. The other important thing with this structure is that we're able to, as a fund of funds, diversify away or mitigate, I should say, the abundant risks that are inherent in this space. And again, this is the thesis that while we believe that we have exceptional managers that do an exceptional job as venture capitalists that we invest in, nonetheless, all of them may be right or may be wrong about the teams and the technologies that they're picking as the winners. And there are externalities that they can't control that are regulatory, that may relate to geography, certainly that relate to timing that they can't control and probably can't predict, related to macro and risk on, risk off, and liquidity flow, driven impacts that absolutely affect this space. And then there are competing technologies that are not just individual investments, but that are entire paradigms that are competing narratives for how these technologies will end up expressing in the world. And if you're not careful, you can get overly concentrated on something that sounds really good, and that in fact ends up not being the winner. So we think diversification, for a lot of reasons, is really fundamental. We've endeavored with the structure, which we call a liquid venture hedge fund of funds, to provide that venture scale return potential with more liquidity than you would typically get from a venture capital fund, more ability, that is, to dollar cost average over time and to take risk off the table over time, and also with a degree of diversification that you are very hard pressed to get with any single fund investment, let alone a portfolio of direct investments. So we think that is really why it's really the structure that has enabled us to outperform most of our benchmarks over time. So the other nice thing about this is it's not only good for managing systematic and non-systematic risks, but it also is potentially a great contributor to the IRR that you can get from investing in this industry, in this asset class specifically. And the reason for that is that a lot of the investment opportunities that are available at early stage, the venture-like investments, are not in company equity. They're in token rights to the tokens that are launched as part of a blockchain-based protocol or product. And in this case, the tokens are a fundamental part of the functioning of this technology. So rather than waiting for a liquidity event for your equity on a company cap table to become liquid for you through perhaps an IPO or a merger, instead, you get liquidity really when a product launches. And that, yes, there are strings attached. Yes, there are issues of whether you not being able to dump your entire position on a market when it's thinly traded. All those things still pertain. But nonetheless, you often get liquidity of a form within a year of making an initial investment in a very early stage team or technology. And so that not only requires a whole different set of skills and tools on the part of our underlying venture capital managers to manage that appropriately. You really have to be a good liquid asset portfolio manager and a good VC, we think, to be a good VC in this industry. But also, we have a lot more optionality. We can double down. We can take risk off the table with a lot more agility than we could in a traditional tech equity venture capital context in any other asset class. And if we, or I should say our underlying managers, do it right, then we have the ability potentially to compound our IRR through faster recycling of investments than we otherwise would be able to. So this is one thing we really like about this structure. We believe it provides the opportunity to, especially in bull market regimes, generate really outsized potential returns. But just as importantly, we think it's a signal for what kind of skill set you want to invest in, the managers that you invest in. If you invest directly in a venture capital fund in this space, we think it's really important that you pay attention to their ability to manage a liquid asset portfolio as well, which is often quite a different skill set. So what are we investing in? Well, I mentioned that the, as we call it, liquidity use case, which is many use cases related to traditional financial transactions and industry players, is further along than what I call the Web3 use cases that we bucket under the label of identity. Both of those use cases, however, are really dependent on infrastructure of various forms. And we think we're still at such an immature stage of this industry that the best bet, in our view, is to invest in infrastructure. And there are a few different things that we mean by that. One is literally what we call infrastructure services and developer tools. So these are the tools in the toolbox that software engineers are using to build blockchains and to build projects on blockchains. And so that's the picks and shovels is the analogy, of course. Second, we invest a lot in what we would call trading exchange and investor services. So the big institutional players that are coming with a lot of their own AUM, as well as with their own needs as consumers of and users of blockchains for their purposes of their business models, they depend on service providers that are expert in this industry and with these technologies. And we are endeavoring to invest in the service providers to the largest traditional financial institutions on the planet that are now adopting and consuming and contributing to blockchains. So we think that that's a good risk on bet to make at this time when institutions are adopting, but the zeitgeist is not positive on the space, generally speaking. Number three, we invest in the blockchains themselves, and we do that primarily these days in what's called layer 2 infrastructure. So the if you will, blockchain components on top of underlying blockchains like the Ethereum blockchain that make the Ethereum blockchain better tuned to specific use cases, that make it more scalable, in some cases that make it more secure, that make it more usable for the end uses that we think are actually where you actually get utility out of the underlying technology. So we've moved up from layer 1 blockchains, which Ethereum being a good example, which might have been where to invest in circa 2017 during the last beginning of the last spike, or the end of the last cycle prior to the last bull market. And now we're up to what we call layer 2. And so the industry has matured, but we're still at the level of investing in the picks and shovels in the underlying infrastructure as we think the best risk-adjusted return potential for the next cycle here. We can't time the market. We've, as I said, demonstrably not timed the market well, and yet we believe that we've done quite well relative to what else you might have invested in. And we believe that's primarily because of our structure. Nonetheless, you can't argue with the fact that it's better to invest, in our view, if you're a long-term investor, not at the peak of a market cycle. And we are certainly not at the peak. We've come way, way down. Your guess is literally as good as mine about when we come out of that, and is driven, I think, primarily by macroeconomic liquidity issues that I can't predict, let alone control. However, I feel good in making investments in this space at this time when we're way, way, way below the peak. And we analogize it loosely to the end of 2019. And we'll see if history repeats itself, but we think that this is a better time to consider entering the space and to start dollar cost averaging into the space, certainly than it would have been 18 months ago. Our team that is doing this is a very diverse blend of traditional financial backgrounds from Wall Street to very large family offices, blended with people such as myself that come from a deep background in working on mass collaboratively built open source software projects at a global scale. And that may be obvious why the former is important to have people that know what they're doing in terms of managing this kind of financial product and this kind of regulated industry. The latter is particularly important, we think, in this industry because everything in blockchain technology, by and large, is built on open source software and open standards. And so the authenticity of knowing how to, caring about openness and in these technologies, and also knowing how to navigate that world of open is important DNA for being able to diligence teams and technologies and to ultimately be able to make good investment choices. So we think we have an important blend of skills in order to be able to do that well. This is probably very small on your screen. The take home here is radically volatile. Don't invest in a fund product like ours with anything but a strong stomach. And nonetheless, we believe that the volatility is worth it. We dampen it a bit relative to the indices, but nonetheless, it is a very volatile asset class. And we think that that is fundamental to keep in mind. And therefore, again, the dollar cost averaging that Joe spoke to is really fundamental to doing it right. We try to make it really simple. Building this kind of portfolio on your own would be quite an undertaking. We wrap it into a very traditional hedge fund structure. So US-based entity, offshore feeder for non-US investors or non-taxable accounts, 2 and 20 fee structure. As I said, a 1-year lockup, much more liquid than, or much earlier time frame that you could take risk off the table than you could in a traditional venture capital fund. The ability to invest new capital any month and reporting on a quarterly basis. So we try to make it simple and easy and accessible to get into a world that also has some very unique and complicated dynamics underneath the hood. So with that, I'll stop and say thank you very much for your time and attention.
All right, great. Thanks very much, Andrew. Comprehensive and useful. And I want to get to some questions. There was one that came in while you were presenting, but a couple things that I got to do before that. So let me just take back the screen share controls, and I'm going to show you one more thing that I'm obliged to show. And sorry for the overhead, guys, but this is important. So please note that the disclosures at the end of this deck, specifically the links to Form CRS and the Reg BI disclosures. We encourage participants who may not be familiar with an offering like this or the parties involved to read them. And if anyone has any questions, they can reach out to compliance@stonehaven-llc.com. Okay, so that said, we're going to get to Bill, who has joined us. Bill, if you can come off mic if you're able, where you are. And I was really struck by your comments on the 361 Firm Investor Survey 12 from Newport in July. So I can hear you now. Can you take us until about 250 or so? And can you elaborate on what you told us there in the 361 Firm Investor Survey?
There we go. Dan, can you hear me?
Yep, I can hear you.
Okay. All right, good. So apologies. I am at the airport. So things are a little bit jumbled up. Flight was late, but I think that you all had a terrific introduction to the blockchain space. I missed a lot of what Joe had to say, but I know that his structured approach to investing in VC is like super important, and especially in this space. And also for oh, hold on, sorry. So getting to your question, Dan, it was interesting in terms of the community survey where we saw an interest in digital assets, but there is a distinction made by the community between blockchain itself and then sort of financial, non-financial approaches for that. And I think that essentially you could boil that down to the difference between the blockchain technology and the underlying technology versus crypto. I think with the FTX debacle that we've had, interest by investors has certainly cooled considerably on anything crypto related, but there seems to be sort of a base interest in the technology itself. And having been both on the LP and the GP side, I think that's a very interesting distinction in the sense that, going back to 2018 when I was at Morgan Creek and involved in the Blockchain Opportunities Fund there, a couple of the catchphrases that we were looking at was one, invest in innovation, and two, actually, as Andrew said a number of times, look for the picks and shovels opportunities. And clearly, we believed that blockchain was a fundamental technology that had the power to transform business, transform finance. These are all like heady statements, but if you really sit down and look at it with cold objectivity, it does have that potential. So the ability to invest early into this space was very valuable. Now, again, as Andrew pointed out, blockchain and digital assets are highly cyclical. They are highly volatile, and you want to be very careful about sizing your position properly because there is the potential for extreme volatility to the downside, as we've all seen. But I think that carefully sized and properly placed, you have tremendous potential. And again, definitely want to emphasize the fact that it's a long-term play because we're still very early in the cycles. There's a lot to be done. There's a lot to be fleshed out. So I think that as investors, it's certainly an area to look carefully at, and it's one that is probably going to pay off not quickly, but over the long run, there could be some significant gains that accrue to this space. I just, perhaps maybe one last comment as well. Going to Andrew's admonishment about diversification, and no doubt Joe probably spoke to this as well. When I was at one of the family offices, we had beginning to build initial positions into a number of verticals. We were actually doing mining. We were looking at the venture side of it, and then we were also investing in the coins as well. So in that sense, we had a lot of areas, a lot of bases covered, and we're sort of beginning to spread our bets, not wanting to concentrate in any one particular area. But I think again, there's so much promise, across the space that diversification in this sense is one that should be very much additive. And you're not going to be losing out. But again, it's being able to pick your spots carefully and being able to size appropriately.
Okay, great. Oh, and I can see you too. Hi, Bill. Nice to say hello. Okay, yeah, very good. All right. Thanks for the comments. That was very helpful. So just before we go to the Q&A, and there's one person I'm going to call out to get this rolling in a second, I did want to just cycle back to the beginning because it did occur to me that my slide share either got stuck or some people might have joined late. So I was showing this. Notice at the beginning, sorry for the overhead again if you've already seen this, but I gave you the disclaimer on the bottom right about 361 from Capital. So that bit of overhead being done, let's resume the Q&A. And Andrew Fish, I'm going to pick on you. You had an interesting comment during Andrew Hoppin's presentation, but I have to admit, ignorance on that one, on that use case. Do you care to elaborate and get the Q&A rolling?
Sure. I actually picked it because I think everybody can easily understand in one sense. Andrew, you brought up a sort of connection between payment cards, peer-to-peer trading of rewards. I think everybody here probably has an airline rewards account, maybe a Starbucks card or more. It's a potentially fascinating thing because, as you described, blockchain, maybe it's a good application. There certainly isn't anything out there that would solve for that. Do you want to dig a little deeper, or am I just missing sort of a topic not worth?
No, I love talking about it. And in fact, we have two underlying investments, and one direct actually, which is a very unusual thing for us, and then one through one of our underlying funds in this domain. And the reason is because we think it is really one of the strongest candidates to be an early, what we call Web3 use case, or sort of a decentralized co-op version of a traditional centralized business that could actually get mass market scale. And there's a lot on the financial transaction side and the payment rails side of things that we think are ready for prime time today, real world asset tokenization, et cetera. But we think Web3 so-called is further behind. And we think loyalty and rewards is where we may actually first see the breakthrough to mass market adoption of these technologies for consumer facing purposes other than stable coins and remittances and sort of financial transactions. So with that as preamble, what we really are excited about, two things. One, and we've learned this all through our underlying investments, is that the largest payment cards companies in the world and some of the largest brands with loyalty and rewards programs in the world are encumbered by those programs. They cost a lot of money to maintain. They are suboptimal in terms of their efficiency for those companies relative to what they believe they could be in two ways. As I said, cost a lot of money, error prone. There are significant risks, financial, regulatory, and otherwise, in managing that currency of their own properly. And then in terms of innovation, it's hard to change things. It's hard to evolve that infrastructure and allow new ways of sharing of those currencies to happen. If you put that power in the hands of your consumers, the people that you're actually trying to incentivize loyalty from and give rewards to, and allow them to innovate and transact peer to peer, the hypothesis is that it'll be a much more compelling loyalty and rewards program. On top of that, because of that greater degree of activity, you'll be able to get more data insights about those consumers and what they actually want. So that's why these companies are doing it. The other thing that is really material, which I touched on very briefly, is that at the same time, those same consumer brands, those same consumer products in some geographies like Europe in particular are going to be increasingly regulated in terms of their supply chain provenance. And so the same technology that can allow you to enable you and I to transact our maybe our Best Buy rewards points might also permit Best Buy to better track literally the carbon footprint of that computer, that laptop that I bought at Best Buy, in a way that could help them meet what would otherwise be extremely expensive and difficult regulatory compliance obligations. So there's a bit of a excuse the analogy, but or the metaphor, but kill two birds with one stone opportunity in using these technologies at an item level and at a rewards point level using blockchain. So two different companies competing with each other. Really excited about both of them, and we think the space is a real winner.
And Andrew, can you add a layer to that, which I think is going to be important, at least to everyone, is the security layer you talked about?
Yeah, so there is, anytime you've got something that is akin to money in a centralized database, there's significant risk to that being corrupted either maliciously or unintentionally. And so we're talking about large dollars that are involved in large obligations that these companies have to their consumers. And we're talking about managing a loyalty and reward system centrally. There are different risks certainly that come with doing that in a decentralized manner, and instead of using a database to store all of this proprietary currency, if you will, instead having it be decentralized and really literally in the wallets of your consumers, and enabling them to transact that peer to peer and basically be their own custodians of those assets. So it's not that that's without risk, but it does shift the burden these companies believe, our understanding is, away from them in a way that enables them to take more good risks, to innovate more, without it being such a existential risk to their existing platform that they just don't try it. And so we think it'll be the innovation benefit that comes from being able to shift some of that perceived risk out to your consumers, rather than being incredibly risk averse within your institution because you have to manage it all centrally.
Great. We're coming up on the end pretty quick, but there's another question in the chat, so I wanted to get that in there if we can squeak it under the wire. Paul, you asked about real world assets and the dreaded stablecoins topic. What was on your mind?
Yep, thanks, Dan. Andrew, I've been spending a lot of time looking at real world asset platforms that want to put real world assets that are generating yield on blockchain platforms. And a big driver of this is that stable coins like to have some form of cash flowing asset for their for their underlying business to earn yield. Obviously, they want very safe assets to do that. Are you guys looking at? Are you exploring that in your investments? What kind of platforms do you look at, and I guess how big do you think that business could get?
Yeah, so all the way up, sort of the stack of the ideas that you outlined, we are interested and in some cases invested. So it's certainly at the level of the underlying blockchain's infrastructure that enables something like PayPal's stablecoin to exist. It's built on the Ethereum blockchain. It is certainly at the layer of allowing that Ethereum blockchain to scale and be able to be used at low cost, which would be layer 2 infrastructure on top of the Ethereum blockchain. And then it goes up, yes, to the level of the innovators in the stablecoin use case. And there are a bunch. So stablecoin created their own stablecoin for a reason, because it's a pretty darn good business for them, potentially, both in terms of cost reduction for some of their settlement obligations that they otherwise have, as well as their ability to generate revenue from basically having control of their own of that currency. But there are lots of competing approaches, right? And they're competing in terms of things like, what are these stablecoins backed by? What protects their peg to, in most cases, $1? Can you do things with that blockchain to reverse a transaction if there was an error, or for regulatory reasons, you might want to reverse a transaction? Or is it more, some would argue, censorship resistant, more resilient, more disconnected in the eyes of some, a benevolent way from traditional financial systems? There are, without adjudicating on the merits of any of those views, there's a lot of innovation happening in stablecoins. And so we, for example, would be invested, yes, at the layer 1 level of blockchain, layer 2 level that makes those blockchains more useful for this type of purpose. And then, yes, at the level of the entities that are involved in the ecosystem of a new stablecoin. For example, we were just on the phone with one entrepreneur this morning talking about a novel way to make an Ethereum-backed stablecoin that really doesn't rely on any banking at all, to keep a dollar peg that uses an innovative hedging mechanism to ensure that. They're a company raising at I believe it's a $10 million valuation for a business that we believe could be a many billion-dollar business if it works. So that's the kind of opportunity we're looking for, and we think stablecoins is an entire class that is really important to look at in the space.
Great, thanks. So I don't want to cut you off, but we are getting right up until the end here. We started a few minutes late, but people are going to have to go. So I think I'm going to give a little summary and wrap up there, if that's okay. So some of the takeaways that I heard from today: blockchain's not just for crypto, and that not just for financial use cases either. And that came from you guys, the 361 community. We had some Q&A on the non-financial use cases that are interesting. But what did we learn today? That nobody can time the market. Blockchain's highly volatile and cyclical. So what do you do instead that gives you the exposures you want, and when? And how do you achieve diversification? As Joe said, please diversify. And we've seen an example today. So here's the call to action. Let's make this actionable. If you want to meet any of today's panelists for further discussion, let us know. Give us feedback offline. Some of you already have, and that was welcome. So what was good? What wasn't? What's actionable? And if you want more of something, what would it be? Do check out on the slides here that I'm showing the upcoming events on the 361 events page, 361firm.com/events. Please register on the website if you haven't already for further content. And for deeper content for qualified investors only, such as today, continue to indicate your interest in the specific sessions to mark by the diagnostic on the 361 website. So thanks to the panelists, Andrew, Joe, Bill in the airport, and I could see you. Great background. Thanks to the 361 team for the excellent execution. Thanks to all you guys for listening. And back to Jim at 361. And you're on mute.
Never fails, but thank you. Thanks to everyone, especially our panelists, but also the audience for some great Q&A. We have captured video, so if we need to make it available at a later time for a redo, we can do that. And otherwise, we appreciate your interest and your ongoing support. So that's it for now.
Very good. Thanks, everyone. Talk to you soon.
Thanks all.
Bye-bye. Thank you.